So welcome everyone to this amazing revision session, where we are going to revise Index 110 CFS. Okay, and the best part about this revision is this is revision which is exclusively for my lovely South India students who are enrolling for the full English lectures or who are willing to see something good in FR which is in 100% English. Okay, so here we are with the revision of Index 110 in 100% English. Acha, do remember here we will revise the concepts along with the questions. Wow, sir. Okay, so beautiful, so elegant, just looking like a wow, sir. Very good. So we'll do this part. Also, before starting, if you have already enrolled for the lecture, good to go. We already have the notes. Just keep the notes with you. If you haven't enrolled, if you wish to enroll, you can enroll my lectures on bbvirtuals.com. They are available. Okay. Apart from this, I will share the board notes, whatever I write on board, on the Telegram channel. You can download the board notes and join the Telegram channel. Okay. Link is in the description. And if you are watching this revision, if you found this helpful, then subscribe. Okay. Anyways, so let's start the revision in 3, 2, 1 and go. First of all, Index 110 name CFS accounting for subsidiaries. Okay. Now when we talk about accounting for subsidiaries, do remember one thing. It is a continuation of what we study in Index 103. Okay. Like what we did in 103. 103 talks about the CFS on day 1 when you acquire the control. 110 talks about the CFS on year end. On year end, suppose you acquired any company on 1st April 2012. Now year end has come, 31st March 2013. How will you prepare the CFS on year end? That is what this Index 110 will talk about. Simple? Okay, sir. Now, here we have to follow the steps of 103 again. I'll tell you why we have to follow the steps of 103 again. Because here there was a basic issue. What was the basic issue? That even if you are preparing the CFS on day 1, the goodwill amount is missing. Remember in 103 we used to find the amount of goodwill on date of acquisition by following the 6 steps. That amount is missing. So we have to follow the procedure again. Okay, first we will find the goodwill on day 1. Then through that we will get the goodwill on year end also. Okay, so that is known as procedure for consolidation. So here also, like always, I have given a stepwise approach. Okay, step number 1. Now in 103 there were 6 steps. Okay, one was identifying the acquirer, second was date of acquisition. We skip those 2 steps. Okay, and we directly come on towards this step, calculation of PC. Okay, so step number 1 is calculation of PC on date of acquisition. This how to calculate? We already know as per Index 110. What will come? Cash, shares, deferred consideration, contingent consideration, everything that. Then we have to find the INA. INA, how we used to find? We used to do assets at fair value minus liabilities at fair value. We used to get INA. This was the method taught to us by Index 103. But there is one more method which Index 110 will teach us. In case if you have studied before, it is known as equity capital plus other equity. Other equity bifurcate into pre and post. Remember this much? Okay. We will do it. Don't worry. We will do solve the examples also. Then step number 1 PC, then INA, then NCI. NCI, we find out date of acquisition. It can be as per 2 methods, either fair value method or PSNA method. Or we find the NCI on year end. Okay. How do we find on year end? We will discuss this in examples. Then goodwill slash GPP, PC plus previously held investment if any, plus NCI minus INA. You will get goodwill on date of acquisition. So for this we followed all the steps. Now one more thing. But this is the goodwill on date of acquisition. In 110 we prepare the CFS on year end. So sir, can the goodwill amount change from date of acquisition to year end? Yes, it can change. How? Amortization. Goodwill is never amortized. It is only tested for impairment annually. So you will less if there is any impairment. Okay. Then these were the 4 steps. What was it? PC, INA, NCI, goodwill. Okay. It is just like there were 6 steps in business combination. Remove the first 2 steps of that. You get the 4 steps. Okay. There is one extra step, that is consolidated other equity. What is the meaning of this? When you prepare the CFS, in CFS, what will be the other equity? Remember, only parents other equity will come. So that is nothing but step number 5, console other equity, where you will take the other equity of parent. But yes, some adjustment can also come here, that we will discuss. Okay. Now before moving towards the example, did you remember there can be 2 types of procedures? First is where you are preparing CFS directly without SFS. This is what we did in Index 103. Remember, where in SFS there is no entry passed for takeover of subsidiary. So we directly used to pass the entry in CFS because 103 we learned the CFS on day 1. So we used to do INA account debit to PC to NCI. If difference used to come, we used to say goodwill GBP. But what if the CFS is prepared through SFS? Now what is the meaning of through SFS? That means in SFS you have already recorded the investment. So if you invest in subsidiary, In SFS, you record investment in subsidiary to whatever you have paid to cash shares, whatever it is to PC, that means. Okay. So in SFS, this entry has been passed. Now, after passing this entry in SFS, you are preparing CFS. So if you have recorded the PC directly in SFS, you should not give the effect of PC again in CFS. Why? Because then it will book the PC double time. So what will I do? Instead of recording the PC, I will eliminate the investment. Why? Because in CFS, we are recording all the asset liability of subsidiary. So no need to show the investment separately. Simple. So we will eliminate the investment. So it will be INA to NCI to investment. Okay. Then differentiate goodwill GBP. Logic also I have made you right here. Remember this much? Okay. So one more thing. When we in 110, mostly we will do to this method only, where in SFS entry has already been passed. Now in 110, the amount of PC is not given directly. So do remember, you can see the SFS, you can see the amount of investment. Whatever is the amount of investment, that will be the amount of PC. Because to record the investment, you must pass the entry investment to PC. So through the amount of investment, you can get a hint of PC. Do remember that. Okay. Chalo. Now let's start discussing the examples one by one. Okay. So the first example number 1. Okay. That is on page number 30.11. What is it? 30.12. Example number 1. What does it say? So let's say we have a balance sheet. Year end is 31st March 17. In this example, it was a very basic example where even the date of acquisition was 31st March 17. So year end is 31st March 17. Date of acquisition 31st March 17. It says prepare the balance sheet on 31st March 17 only. So here the date of acquisition and year end are same. So ideally it is not a question of 110. It is a question of 103 only. But anyways, we'll try to solve as per the procedure of 110. How will you solve it? Take the PC. PC is not given. So look at the amount of investment. You have recorded the investment in SFS. This is your PC. Because to record this, you must have passed the entry investment to PC. So your PC is 25,000. Okay. Then step number 2, INA. Because the date of acquisition and year end are same, you can calculate INA as per both the methods. You can do asset minus liabilities also. That is 24,000. But there is one more method as per 110. That is equity capital plus other equity. Through this also you will get the same answer, 24,000. Then NCI on date of acquisition as per PSNA method you will get. Then you will compute goodwill, prepare the balance sheet. Okay. In balance sheet, just remember investment gets eliminated. Okay. This was a basic question. Nothing extra is there. So in this example number 1, we learned that INA can be calculated using this method also. Equity plus other equity. Then we came on towards second example. Now here the balance sheet is given on 31st March 18. But what is the information? That investment was made on 1st April 17. We made the investment on first day of the year and opening other equity is given. Prepare the balance sheet on year end. Now this is a pure question of 110 where we invested on first day, but the balance sheet is asked of year end. Okay. So has the investment been recorded in SFS? Yes. Okay. So we will eliminate the investment and this is the amount of PC. So how will you solve this? First PC, then INA. Can I do the INA by directly taking asset minus liabilities? The answer is no. You cannot do it like that. Why? Because this asset liabilities are of year end. I don't want the INA on year end. I want the INA on date of acquisition. So what will you do? You will take the equity capital plus you have to take the other equity. Now for other equity, you will bifurcate into 2 columns. The column of pre, the column of post. In pre, you will write the date up to date of acquisition. And in post, since date of acquisition till year end, how much period is there? So in pre, up to date of acquisition, other equity will come. So is it given how much was the other equity on date of acquisition? Yes, it is given 4,000. So we will write 4,000 here. Okay. Now, if you see closely, the total other equity of subsidiary was 6,000, out of which 4,000 is opening. So in post, how much will come? Balance 2,000 will come. So this 2,000 is nothing but the profit earned by subsidiary since date of acquisition. That means after date of acquisition, how much profit did subsidiary earn? 2,000. Okay. Now what to do with this other equity? So we first want the INA. What is INA? Equity share capital on date of acquisition plus other equity on date of acquisition. Together this forms INA. So 10 plus 4, that is 14,000. Sir, but equity capital was given of year end. We assume that during that there has been no new issue of shares. Okay. What to do with this post acquisition profit? This will get bifurcated between 2 parties, parent and NCI, in the ratio of stake. Simple. Parent's profit, parent will add in the respective reserves. NCI profit, NCI will add in the year end balance. So then we find NCI. NCI on date of acquisition, NCI on year end. So why do we need to do NCIs? The first NCI on date of acquisition will be useful to calculate the goodwill amount. Okay. Second NCI on year end will be used when you prepare the balance sheet on year end. You will add this NCI. Do remember. You will make a mistake here. While finding goodwill, you might by mistake take this year end NCI. So do remember this. Okay. Chalo. Then you will do goodwill PC plus NCI minus INA. You will get goodwill. There is no impairment. So goodwill on day 1 and year end is same. Then console other equity, take parents other equity, then add the parent share of profit. Simple. Clear with this? Okay, sir. Prepare the balance sheet, you are through with it. Then we come on towards example number 3. What is there in example number 3? Only one part is different. That date of investment is 1st October 17. That means you have invested between the year. But the issue is, so that means PC first step is same. Now come to IND, INA. In INA, you will add equity capital, that will remain the same. Other equity will take pre and post. In pre, it will come to date of acquisition. Date of acquisition was 1/10/17. Okay, but the issue is the opening balance is given of 1/4/17 only. Okay, you acquired the company on 1/4/17, so they have given the opening of 1/4/17, but we don't need the balance of 1/4/17, we need the balance of 1/10/17. Okay, in post only 6 months will come because you acquired on 1/10/17. So post period will be after date of acquisition till year end. Only 6 months will come. But here when you take 2000, this is the profit of 12 months. That means in pre, the balance should be of extra 6 months. Instead of 1/4, it should be till 1/10. And in post, instead of 12 months, profit should be only of 6 months. So there is something which we know as time adjustment. We do it. Okay. In time adjustment, take the profit of post and take the number of months. That is 6 months. From first day till date of acquisition, there is 6 months, right? 6 months. So take post profit into 6/12. Whatever amount you get, you will reduce from post, you will add in pre. As soon as you add the 6 months profit in pre, opening plus the 6 months profit will give you the balance of 110. As soon as you reduce from post, from 12 months, you reduce 6 months profit. The balance is only the remaining 6 months profit. Simple. This will become part of INA. This will bifurcate between parent and NCI. So this is what we learned in example number 3. Then we came towards example number 4. What is there? Sometimes it is there that in other equity, two bifurcation are given, retained earnings and other reserves. Okay. And sometimes it says that the balance of other reserves is missing. Opening of other reserve is not given. When the opening of other reserve is not given, just remember to assume whatever is the closing will be same as opening. That means everything will come in pre, nothing will come in post for other reserves. So what about retained earnings? Normally it is given. But in case of retained earnings, what we will assume? We will assume that opening is 0. Whatever you earned was in post. Okay. But this case won't arise in exams. I feel it will be always be given. Anyways. Then example number 5 will come. Example number 5 has one of the most important adjustment, that is dividend. How to account for the dividend, sir? It is very simple. Please have a look here now. Okay. Now I can little speed up because now we have built that base. Dividend. Who pays the dividend? Subsidiary pays the dividend. So when subsidiary pays, it books like an expense. And dividend is paid to parent and to NCI. They both book it like an income. This has happened in SFS. In CFS, you have to eliminate the effects of dividend. How will you do it? So subsidiary must have booked expense previously. Now it has to reverse the expense. So it will add back in other equity. Okay. In subsidiary reserve, we will add it back to reverse it. Parent and NCI must have booked the income. So that time they added the income. Now they have to reverse it. So less it. Less from parent's balance, less from NCI's balance. So summarization of this effect is when you want to add back in subsidiaries reserve, you will add back in step number 2 post column. Okay. When you want to less from parent other equity, less from step number 5 console other equity. When you want to less from NCI, less from step 3B NCI on year end. Okay. Do remember my focus is on revision, of course. Okay. Chalo. Now we had this question where investment was on 110/17. Opening balance of other equity was given as 4,000. Then dividend was paid on 1/11/17. Do remember in Ind AS only dividend adjustment is there when it is paid after date of acquisition. Okay. Don't say what if it is paid before date of acquisition. Doesn't matter. That adjustment is not there in Ind AS. Okay. Chalo. So subsidiary paid 10%. 10% of what? 10% of capital of subsidiary. So it will be 1,000. So what are the 3 effects? The first effect is that you will add back in post. So this effect of dividend will come before time adjustment. Okay. Do remember. So we'll add back in post. Okay. Then you will do time adjustment. Very good. Then NCI's share will get reduced from NCI's year-end balance and parent's share will get reduced from parent's year-end balance. That's it. This is what we will do in example number 5, dividend. Okay. Then example number 6, revaluation gain and loss on assets. How will you solve this? Please have a look here. So in this, so now see the hierarchy of step number 2. Okay. What is the hierarchy? First, you take opening, then you will take dividend if any in post. There is no dividend here. Then you will take time adjustment. Then you will do fair value adjustments. Why we need to do fair value adjustments? When you take the capital and other equity of subsidiary, it is only considering the book value of asset liabilities. But sometimes we take over at fair value. So you whatever is the fair value gain loss, you have to take that effect in pre column. So let's say land increased by 5 lakhs. So there is a gain of 5 lakhs on land. Okay. Don't take the whole fair value. We only want the gain amount. Why? Because when we take equity capital and other equity, up to book value figures already considered. We only want the incremental value compared to carrying amount. So that is the fair value gain loss. So if on asset there is an increase, you will have a revaluation gain. So you will do fair value adjustment. So let's say it is said that land increased by 5 lakhs. So I will add in pre-column 5 lakhs. I will say inventory increased by 2 lakhs. So I will add in pre-column 2 lakhs. It says that trade payable increased by 3 lakhs. So increase in trade payable, liability increases, so it is a loss. So revaluation loss on trade payable. Okay, so this is how we'll find the IND. Do remember. Also, while preparing the balance sheet, when you take the land of parent and land of subsidiary, don't forget to add the amount of revaluation gain. Simple. Okay, chalo. Then there was also one more example, example number 7. It was a very good example. What does it say? It says that everything is same except for the fact that the fair value of plant and machinery was 25 lakhs. For plant, they have given the fair value. They have not given the gain amount. We don't want the fair value of plant. We want the gain on plant and machinery. And the rate of depreciation is given. Now, how do I compute this? So don't say that we can compare the fair value and carrying amount directly. This carrying amount is of year end, but the fair value is of 11017. So we will also need the carrying amount of 11017. How will I do it? Please have a look here. So you need to prepare some calculations. First, I have the fair value of 11017. I will require the carrying amount on 11017. How will I find it? We have the carrying amount on year end. Can I say this is after depreciation of 25%? That means this 15 lakhs represents 75%. First, we will find 100%. Through this, you will get the value of day 1. So year end, the value was 15 lakhs. On start of the year, it was 20 lakhs. So during the year, you charge depreciation of 5 lakhs. But we don't want the carrying amount of 1.4. We want the carrying amount of 110. So less the 6 months depreciation from year. So if the full year dep was 5 lakhs, 6 months will be 2.5 lakhs. So this is how you get the carrying amount on 11017. So fair value we have on 11017. Carrying amount we have on 11017. You will get the revaluation gain amount 7 lakh 50. Okay. So we record this in pre. Do remember fair value gain loss adjustments will come in pre. But standard also says if ever there is a gain loss on depreciable asset. If ever there is a gain loss on depreciable asset, in post excess depreciation will also come. So here there is a gain on depreciable asset. In post excess dep will come. Okay. How will you compute the excess dep? It is simple. If excess dep will come in post column. So in post column there were how many months? 6 months. So excess dep will come for 6 months. How will you calculate? If on fair value you calculate depreciation for the 6 months, how much will it be? So it will be, if you calculate fair value depreciation on fair value, it will be 3,12,500. But if you calculate dep on carrying amount, it will be 2,50,000. How come? For the full year it was 5 lakhs. So for the last 6 months it will be 2.5 lakhs. So this is excess depreciation. This is how you will compute excess dep. Okay, so it will be 60 to 500. Reduce it. Okay. Now one more thing. Sometimes you might also say that, sir, why can't we directly do the excess dep calculation on revaluation gain amount? Don't do it like that. Why? I also told in class that whenever the rate is given, whenever they have given the rate of depreciation, the method is WDV. In that case, find like this only, the amount of excess dep. But whenever the life is given, life, the method is SLM. In that case, you can directly use the gain amount and find the excess dep. Okay, don't worry, we will solve the same in question also. Everything else remains the same. Step 4, step 3, step 4, step 5, and then the balance sheet. In balance sheet, do remember, in plant and machine, when you add the gain, don't forget to reduce the excess dep as well. Okay, chalo, done. Now, we did till example number 7. Now, based on this, there is a good question, which is ICA's favorite question, come in exam multiple times, come in mock test multiple times. Illustration number 64. So the best part of our revision is we don't only revise the concepts, we also revise the questions. Till here, I hope it is clear. Guys, yes or no? Till here it is, the revision is clear? Okay. Acha, also, while seeing the revision video, it is possible that you might not recall certain examples or certain adjustments. Just do a star mark. So that once the revision is over, you can do a self reading of that particular adjustment so that you can be through or you can be clear with those adjustments. Okay, chalo. Illustration 64, what is there? So it says Ram acquired 60% of Krishna Limited. Okay, so Ram is the parent, Krishna is the subsidiary. Very good. On 1st October, so we have acquired in mid of the year. Very good. The summarized balance sheet of two companies are given below. Ram and Krishna, it is given. Investment in Krishna is given. So this is the amount of your PC. Do remember that. Okay, then everything else is given. In other equity, there are two reserves. Other reserves and retained earnings. Very good. The retained earnings of Krishna showed a credit balance of 60,000. So this is the opening balance of retained earnings, 60,000. Out of which 10% dividend was paid. Dividend of 10% will be calculated on capital amount. So 4 lakh into 10%, it will be 40,000. Effects you already know. Then it says that fair value of plant is given. So again, the fair value is given. We don't want fair value. We want the gain loss amount. We already did in examples. We will do it again. Then rate is given. So if rate is given, method WDV. Find the excess debt as I taught you. Then it says following are the increase in fair value compared to the carrying amounts. Okay, so directly the amount of increase is given for remaining assets, liabilities. So if there is an increase in assets, gain. If there is an increase in liability, then loss. Okay. Then if you see closely, the opening of retained earnings was given, but the opening of other reserve was missing. So it is mentioned in the second line that if the opening is missing, assume that the whole closing balance is there in pre, nothing is there in post. Don't remember this much for other reserves. Okay, now how will you solve this? The solution is very simple. Do stepwise. Even if they're asking the balance sheet, first follow the steps. You will never get stuck here. Okay, so date of, see, basically everyone knows that this is a scene question, but in exam our hands don't work. So that is why I give you steps to simplify things. Like we simplified in other chapters, we are simplifying here also. First step is PC. PC, look at the investment amount, write the PC. Then you will take INA on date of acquisition. First take the equity capital of subsidiary. Then take the pre and post balance of subsidiary, retained earnings and other reserves. Now we acquired on mid of the year, but the opening is on 1st April. So you have to do time adjustment. But before time adjustment, there comes dividend adjustment. So first add back the dividend of 40,000 in post. Then do time adjustment. Okay, then do fair value adjustment. For land, inventory, trade payable, it is very straightforward. But for plant and machinery, you have to find it. How will you find? Fair value on 110 is given. Compare this with the carrying amount on 110. How will you find it? Reverse calculate. Year-end carrying amount is given, that is after debt, so 90%. Reverse it, you will get the day one's balance less 6 months debt. You will get the carrying amount on mid of the year. You get the gain of 1,15,000 recorded here. Because this gain is on a depreciable asset, excess debt will also come. Okay, excess debt, because rate is given, find debt on fair value, find debt on carrying amount, you will get the excess debt. Simple. Okay, so what will happen with this 6,57,000 will become a part of INA. What will happen with the 67? It will bifurcate between parent and NCI and the ratio of stake. Okay, then you will get NCI on day one as per PSNA, NCI on year end. Take opening plus post. Don't forget to less the dividend of subsidiary, NCI's share. Okay, goodwill GPP will be there. PC plus NCI minus INA. You will get goodwill on date of acquisition. But we have to see impairment also. There is no impairment here. So goodwill on date of acquisition will be same as goodwill on year end. Okay, then we will get step number 5, console other equity. It is very straightforward and simple. Is this clear to everyone? Write parents other equity, write post, add the post profit, and don't forget to reduce the dividend from subsidiary parents share. While preparing the balance sheet, don't forget to take the effects of fair value adjustments, effect of excess debt. Don't forget this. This is something which you will forget. Okay, so do remember this part. Okay, chalo. So this was your illustration 64. There is one more question which is a very good question, that is question number 4 of our question bank, that is MTP RTP past exam section, question number 4, that is on page number 30.70. Okay, now let's see what is given here. On 1st April, it says A acquired 80% of S. So A is the parent, S is the subsidiary. On acquisition date, capital reserves are given. So directly the date of acquisition, reserves and capital are given. So there will be no time adjustment here. Why? Because you are acquiring on the first day, and on that day only they have given the capital reserves balance. Okay, then now comes the twist. PC is given, information for PC is given. We are not seeing the PC by looking at the investment amount. We will have to calculate the PC here because it is given. So cash 10 lakhs was paid. We gave shares of 2 lakhs, nominal value 1 rupee, market price 1.8. We will issue at market price. Then there was some deferred consideration also after 3 years. So we will take at present value in PC. Now comes the most important line of this question. The shares and deferred consideration have not yet been recorded by A Limited. So there are 3 forms of PC: cash, shares, deferred. So they are saying shares and deferred have not yet been recorded by A. That means in SFS, you have only considered the effect of cash. You have not considered the effect of shares and deferred consideration. So if you have not considered the effect in SFS, we will have to directly consider the effect in CFS. So in CFS, you will eliminate the investment, but you will also have to record the PC, which you gave shares and deferred consideration. Do remember. Achha, apart from this, on date of acquisition, fair value of plant exceeded by 2 lakhs. So gain on plant is given directly. Useful life is 5 years. Because life is given, method is SLM. So excess debt you can directly calculate on the gain amount. Okay, chalo. Goodwill is impaired by 2,58,000. Good adjustment, we will do it. Then NCI is given as per fair value method. Do remember this much. Okay, chalo. Then balance sheet is asked on 31st March 19. Now the important part here is we have acquired on 1st April 17. Balance sheet was asked for 31st March 19. That means in post there is not 1 year, there is 2 years. Okay, so pre and post 2 years are there. Okay, do remember. Chalo. Now how do I solve this? Again, follow the steps. Step number 1, PC you cannot calculate by seeing the investment amount because it was partially recorded. So we will calculate PC in cash, shares, deferred. Okay, do remember cash impact is already there in SFS, so no need to give the effect again in CFS, but shares and deferred, if it was not there, we will give the effect. Calculate the IN. It is simple. Take the pre-amount is directly given, balance will be in post. Okay, dividend not there, time adjustment not required because we acquired on the first day. Fair value adjustment, only one is there, that is plant, and because it is a depreciable asset, excess debt will be reduced. You will get INA, you will get post balance. Do remember 325 is not the INA. INA is capital plus other equity. Most of you will make the mistake of taking only 325 as INA. 325 plus the capital of subsidiary will form part of INA. So it will be 825,000. Then in post 95,000 is there. So bifurcate into parent and NCI and the ratio of stake. NCI is as per fair value. And year end you will say add post acquisition, dividend not there. This we will talk about later. Then goodwill will come. PC plus NCI minus INA, you will get goodwill. Now because NCI was at fair value, remember if NCI is at fair value, goodwill is full. If NCI is at PSNA, goodwill is partial. What does it indicate? If it is a full goodwill, goodwill belongs to parent and NCI both. Okay. So if goodwill belongs to parent and NCI both, and if there is an impairment in this goodwill, both will bear the impairment loss. So if there is an impairment, the loss will have two effects. First, it will reduce the amount of goodwill. Second, this loss will be borne by parent and NCI and the ratio of stake. So parent stake was 80%, NCI stake was 20%. So 80% loss parent will bear. So parent's reserve will reduce. And 20% loss NCI will bear. So NCI's year-end balance will also reduce. So do remember this. So if you can see here, NCI's year-end balance reduced. And for parent, we will reduce the consolidated other equity. So parent's reserves also reduced. Okay. Then while preparing the balance sheet, do remember, apart from the normal asset liabilities, we also have to take the effect of two PCs, that is shares and deferred. How will I take the effect in shares? So 1 rupee was face value, 0.8 was premium. So 2 lakh will come in face value, 1.6 lakh will come in premium. So whatever is the face value will get added in capital. Whatever is the premium will get added in other equity. So I will add in step number 5 directly. Okay. So I added here premium and I added here face value. Simple. Now, apart from this, there was also deferred consideration. Deferred consideration was 3,75,000. But you cannot take 3,75,000 value in deferred. Why? This value was as per 1,417. You know, in deferred consideration, we do unwinding. We are preparing the balance sheet on 31st March 19. So we also want the deferred of 31st March 19. So do the unwinding for 2 years. So when you do the unwinding for 2 years, you get the value of 453,750. So in deferred, you will take the value of 453,750. Also, because you have unwinding for 2 years, it is an expense for you. So because of expense, your reserves also reduce. So in consolidated other equity, you will reduce the unwinding effect. 78,750. So this is also a very important adjustment which you need to remember. So basically this question is over, but there were 3 adjustments in this question. First, shares impact which we took in CFS of PC. Deferred consideration impact which we took in CFS. And goodwill impairment full allocated between both parent and NCI. So summary also I have given in the question for your easiness. Acha, one more thing. What if the goodwill is partial? If the goodwill is partial, then impairment, then partial means goodwill only belongs to parent. If goodwill is partial, then impairment loss will be allocated only to the parent. Simple. Okay guys, clear? Chalo. Then we did illustration number 44 that you can refer. It is a very simple question. Okay. Then after that, we came on towards our examples again. There was example number 8, which says that continuing with example 6 and 7, only the tax rate is given. If this 4-5 words are given, that tax rate is this much, one extra effect will come, that is deferred tax. How will you calculate deferred tax? I gave you a shortcut. See, everything remains the same. Only one extra thing will come. Whenever there is a gain, there will be DTL. Whenever there is a gain, there will be DTL. Whenever there is a loss, there will be DTA. That means if your gain is a positive amount, your deferred tax will be a negative amount. This is a shortcut which I am giving. Logically, we have discussed it here. Because let's say logically, if the land has a carrying amount higher than 5 lakhs, higher by 5 lakhs. So your carrying amount will be higher by 5 lakhs compared to tax base. Okay. So if carrying amount is higher, tax base is lower. We want to reduce the carrying amount towards tax base. So reduce the asset, create a liability. Simple. So this is logical. But in exam, you can do shortcut. Okay. So gain on land is 5 lakhs. So there will be DTL. Gain, DTL. Loss, DTA. Gain, DTL. And if there is a gain on plant, we also do excess debt. So excess debt is a negative figure. So deferred tax will be reversed, positive figure. So if you don't remember, just remember If it is a positive figure, deferred tax is a negative amount. If it is a negative amount, deferred tax is a positive amount. Simple. Okay, this is one thing. Also, when you're preparing the balance sheet, all the DTA details will be netted off and presented as a separate line item. Okay, to remember. Then example number 9. Again, a very good example. It talks about what if it is mentioned in the question that assume inventories were sold at year end and also assume trade payable or settled at year end. If it says this, what to do? So let's say, continue with the example, we booked a gain on inventory and we booked a detail on inventory. If it says assume inventory was sold on year end, whatever you did for inventory in pre, just do the opposite in post. So if you booked a gain on inventory, reverse that gain in post. If you booked a DTL on inventory, reverse that DTL on post. Why? Because if the inventory is sold on year end, that means if the inventory does not exist, so the gain loss which you booked in pre does not exist in post. So just reverse it. Okay, chalo. Same applies for trade payable. Whatever you did for trade payable in pre, just reverse the same in post. Okay. Acha, you will do this only when this line is mentioned. If nothing is mentioned, just book the gain loss in pre, do nothing in post. Like in illustration number 64, Ramkrishna Limited, we booked a gain in pre for inventory and loss for trade payables, but we never reversed in post because nothing was mentioned. Okay. If it is specifically given inventory sold or any liability settled, then only reverse. Otherwise, don't do it. Simple. Clear? Okay. Acha, one more thing. Don't say that, sir, if the inventory of subsidiary sold, then the inventory in CFS will be 0. Inventory in CFS will not be 0. Why? Inventory which was there on date of acquisition has been sold. Subsidiary might have acquired some new set of inventories after date of acquisition, so it can remain. So basically, don't apply extra logic by saying inventory should be 0. No, inventory which was there on date of acquisition has been sold. Anyways, also when you prepare the balance sheet, when you take the gain, also reverse the gain again. So let's say you booked a gain on 2 lakhs of inventory, but that gain has been reversed now. So you will add 2 lakhs less 2 lakhs. Basically in balance sheet you will do this. Okay. And also I have mentioned this. If question specifically mention that inventory was sold, then only reverse everything in post. If nothing is mentioned, assume that no reversal will happen in post. Now based on this, we also did questions 65, 66, 67. What were there in those questions? Come. We will revise that part. Where is it? Here it is. 65, 66, 67. So basically the important question is 67 only, but these three are interlinked. So we will do it together. First 65. It says we acquired 100% on 31st March 12 and the balance sheet is also given 31st March 12 and they have asked the CFS of 31st March 12 only. That is here the year end and date of acquisition are same. Okay. So how will you solve this? Here ideally it is a question of 103, not 110. Why? Because year end and date of acquisition is same. Okay. So we acquired 100%. PC paid was 6,000 lakhs. Okay. So how will you solve this? You will add the PC 100%. INA of orange. Now because date of acquisition and year end is same, you can directly calculate the INA. Doing asset at fair value minus liabilities, whatever it is. Okay. You will get 4,700. You can also do with the method of 110. You can take the equity capital, take the other equity, everything will come in pre only and do the fair value adjustments. Fair value adjustment will come on 2 items, building and inventories. Okay, do remember. Chalo. So we got the INA same. NCI will be nil. Goodwill will be simple PC plus NCI minus INA. We'll get the goodwill. Console other equity only parent. Prepare the balance sheet and homework simple. Then there was illustration number 66, I guess. One second. Did I make a mistake? Yeah. Then there was illustration number 66. Okay. In 66, what is there specifically? Only one part is different, that in 66 we have paid the PC not for 100% but for 75%. Rest everything is same. So your PC is for 75% is 4,500 and your NCI will also come. Rest everything is same. Okay. This was 66. Nothing else is there. Now let's come to 67. That is the important part. Here the story has moved 1 year ahead. We acquired on 31st March 12. Now they are talking about 31st March 13. Okay. So what is happening on 31st March 13? We have to see. So now this becomes a pure question of 110. Okay. How will I solve this? Let's see. So what are the adjustments? First, profit and loss is given. Okay. Then goodwill impairment is given 98. Then for building, you got the gain in pre-column. They are saying that the life of building is 20 years. So here excess debt will come in post. In previous question did not come. Why? Because the period was not there in post. Here there is 1 year in post now because we have moved 1 year ahead. Apart from this, because the life is given of inventories, you can directly calculate the excess type. Also, all the inventory held by Orange on 31st March 12, that is the inventory on date of acquisition, was sold. If inventory was sold, whatever you do in pre, you have to reverse in post. Okay, so how will you solve the 67? It is very simple. Take the PC 4500, then INA. Now the issue with this question is it is interlinked with 65, 66. So the data of pre you will have to copy from 65 and 66. Okay, so equity capital I guess we had of 2000. Then we have other equity. Pre post also will come. Pre 2300 we got from the previous question. How will you get the amount of post? So to calculate the amount of post, two methods are there. Total was 2850. Out of this is in pre, so balance in post. Or current year profit loss is also given. So if this is given, then subsidiary during the current year earned 550. So everything will come in post 550. Because you acquired on the last day of the year, directly the other equity of that is available. So there is no time adjustment, no dividend available. Fair value adjustment, we had a gain on PP. How did we get to know about this gain? We saw from previous questions, of course. Then there was excess debt of 15. Just reverse that part. Okay. Then we also booked a gain on inventory. We have to reverse it in post. Why? Because the inventory has been sold. Rest everything is simple. NCI is there, goodwill is there. But here NCI we calculate as per PSNA method. We don't have NCI as per fair value. So one more important part. The goodwill you get is impaired. So if there is goodwill impairment, now the goodwill is as per partial goodwill. So if it is a partial goodwill, will NCI and parent both bear the loss? The answer is no. Only parent will bear the loss. Do remember this. Remember in question number 4 we did, there was NCI as per fair value. So goodwill was full. So both parties are bearing the losses, parent and NCI. Here the goodwill is partial. So only parent will bear the loss. Okay, do remember. So only parent's reserve will reduce. Then everything else is same. Just prepare the balance sheet. Balance sheet is something which you should practice again and again multiple times, at least in the question which I'm marking or which I'm revising with you, so that you will gain that confidence also. Okay, chalo. So this was the revision till illustration number 67, till Blue Heavens and Orange County Limited. Okay, I hope till here everything you have understood. Okay, yeah. So we revised till Blue Heavens question, right? Now please have a look here. Now the next part is adjustment of URP. Okay, URP means unrealized profit on transaction between parent and subsidiary. So whenever there is a intra-group transaction between a parent and subsidiary, there are two things which you need to eliminate. One is the sales and purchase between the parent subsidiary, and one is the URP element between the parent and subsidiary. Okay, these two things we will have to eliminate. Now, we took one question where parent sold goods to subsidiary. 5 lakhs good was sold for 6 lakhs. So how much was the URP element? 1 lakh was the URP element. Okay, so eliminate the sales purchase. But when will you eliminate this? You will eliminate this only when the transaction happened after date of acquisition. When this sales purchase happened after date of acquisition, then only you will eliminate the sales purchase. And when will you eliminate the URP? When the inventory is still outstanding on year end. The inventory, if parent sold to subsidiary, within subsidiary books, that inventory should remain on year end. Okay, then only will eliminate. So for this, I guess we also had a summary. If you want, you can refer it here. Okay, summary on intra-group sale and purchase and elimination of URP. So if the date of transaction is before date of acquisition, we did the sale purchase before we were into a relationship. So don't eliminate the sales purchase and don't eliminate the URP also. But if the date of transaction is after date of acquisition and inventory is outstanding on year end, eliminate full sales purchase, eliminate full URP. Acha. If date of transaction is after date of acquisition, but inventory is not outstanding, inventory is sold to third party, sales purchase will get eliminated here, but URP won't get eliminated. And last but not the least, if the date of transaction is after date of acquisition and inventory is partly outstanding, in that case, sales purchase will get eliminated completely, but URP you will only eliminate up to the extent of unrealized profit. Okay, on the outstanding inventory. Now, based on this, there were two more discussions of URP. It can be upstream, it can be a downstream transaction, it can be upstream transaction. See, when I say you will have to eliminate the URP, you say console profit loss to inventory 1 lakh, URP element. But whose reserves will reduce? When I say consolidated profit loss account debit, whose reserves will reduce? So for that, you will have to check whether it is downstream or upstream. So how to do that? So first check who sold the goods to whom. If parent sold to subsidiary, that means a big company selling to small company. From big, it is getting sold to small, so downstream. Okay, so basically when parent sells to subsidiary, profit is earned by parent. Okay, so you will eliminate the URP from parent's reserve. That is from step number 5, console other equity. Okay, when subsidiary selling the goods to parent, it is an upstream transaction. Why? From small company, subsidiary small company compared to parent. So small company selling to big company, subsidiary to parent, upstream. Okay, so when S sells the goods to P, it is an upstream transaction. Okay, so in this, can I say subsidiary earned the profit? So we will eliminate from the subsidiary's reserve. That is step number 2, and that also from the post side. We also discussed why we do that. Okay, we discussed the why part. Also, one more thing. On URP elimination, deferred tax impact will also come. Why? Because URP is eliminated only in accounts. So in accounts, your carrying amount comes down. But in taxation, the inventory value stays at the value including profit. Okay, so here the carrying amount came to 5, but the tax base remained at 6. So in URP case, always DTA will come. And where will the deferred tax impact go? The place where you eliminated the URP, just below that deferred tax impact will come. So if you give the effect of URP in step 5, deferred tax will be added in step 5. If you reduce the URP from step 2 post column, you will add the DTA in step 2 post column. Simple. Now based on that, we did illustration 38, 39, 40 and 41 also. It is basic question based on the concepts only. Just revise it once. Okay. Then the next concept which we discussed was step acquisition. Now what is the meaning of step acquisition? So there are two cases here. Let's say in the first case you had 15% stake. Then you acquired another 60% stake. So here you gained control in the second stake. Okay. So this accounting we already discussed in 103. So this previous 15% is known as previously held investment. So you will follow the 6 steps of business combination from the second date, that is 1st April 13. Okay, and this previous 15% will be treated like a previously held investment and taken at fair value on date of acquisition. But here is the new case where you had already 70%, you acquired 10% extra. You already had 70%, so you already had control, you gained 10% extra. So here you will not follow the 6 steps or recompute the goodwill. No, you will not do any such thing. But what will do then? If my stake was 70%, can I say NCI stake was 30%? Now, if I acquire 10% extra, my stake increases and NCI stake reduces. So my stake will go on to become 80%, but NCI stake will reduce by 10% and go on to become 20%. So basically what will happen here is only NCI will reduce. Only NCI will reduce. So how will you give the effect? Because you are acquiring 10% extra, you will credit the cash bank because cash is going out. Also, because NCI is reducing, you will debit the NCI proportionately. You will debit the NCI proportionately. Why? To reduce the NCI, you have to debit it. Difference goes to console other equity. Why? Because if NCI is an equity item, if any equity item increases or reduces, the difference goes in console other equity. This is step acquisition. We have so many questions also based on this, but this is the basic concept. Okay. Apart from that, next point is disposal of shares in subsidiary. Now, what is the meaning of disposal? First case, disposal means sale. So you had 70% stake. You sold it 10%. You still have 60%. Can I say before also you had control? Now also you have control. So by selling this small stake, it is not resulting in loss of control. So we will say disposal without loss of control. So what we'll do? If my stake reduces, NCI stake increases. So record the NCI. So 2 NCI, debit the cash bank because you're selling it. So you will receive cash. So cash bank debit, 2 NCI, difference goes in console other equity. Why console other equity? Same reason, because NCI is an item of equity. Any difference in NCI will go in console other equity. But second case is crucial. Let's say you dispose the shares of subsidiary and it results in loss of control. How come? You had 80%, so NCI was 20%. Now you sold a 70% stake. So your stake was only 10% now. So can I say control is gone? So if control is gone, remove everything which belongs to the subsidiary. So one by one, remove everything. Remove the INA of subsidiary, remove the NCI of subsidiary, remove the goodwill / GBP of subsidiary. Okay, subsidiaries only this was recorded, we removed it. Apart from that, because we are selling 70%, we will receive the money also for 70%, so cash bank account debit. Now, what about the 10% stake which you still have? It will be recorded like a investment retained. Okay, so you will do that. So like this, on a debit side also you have 100%, on a credit side also you have 100%. Again, I'll repeat, remove the INA, remove the NCI, remove goodwill GBP. Okay, because you are selling, you will receive the money, so debit cash bank. What about this retained stake? You will record this like a investment retained at fair value. difference goes in loss of disposal. Okay, do remember this. That's it, nothing else is done. Do remember this step acquisition and disposal. These are the concept. Main clarity we will get once we do the questions. Okay, so are you comfortable with the revision till here, till disposal of shares? So let's continue. We have done till disposal of shares, right? The concept of disposal of shares is done. Now, if you can see, we have one question, illustration number 29. Just give it a read. Okay, we will try to revise all the important or tricky questions. The ones which are very direct questions, you can just give it a read. Okay. Acha, come to illustration number 34 of our notes. So if you see this question, what was there in this question? Let's see. It says that XYZ purchased 80% in ABC. So XYZ is the parent, ABC is a subsidiary. For PC is 140 lakhs. Then subsidiaries, capital and profit loss balance is given. Normally we use this to compute the INA. Okay, through that method which we learn in IND AS 110. But if you read the question wholly, the INA is also directly given. So use a direct given INA. Anyways, during the year ABC means subsidiary earned a profit of 20,000. This is the post acquisition profit which gets distributed between parent and NCI. And it is said that and later on it declared a dividend of 30,000. The interpretation of later on is that the dividend is not paid in the current year because profit is earned in the current year. Okay, and then they use the word later on. That means the dividend has occurred in the next year. Do remember. So in current year, no effect of dividend will come. Okay. Then they are telling us to to find the value of NCI as per the fair value. And what is the fair value? It is on the same as per share basis of purchased interest. That means if you have paid 1,40,000 for 80%, using this ratio, you can find the fair value of NCI for 20%. Okay. Then INA fair value is given. What they have asked? They have asked the entry for dividend in SFS of parent whenever it is received. So they are asking the dividend in the SFS of parent whenever the parent receives it. That means are they asking the entry for current year of dividend? No. Whenever the parent receives, we need to pass an entry. What entry will the parent pass? For entry it is simple. Bank account debit to dividend income in SFS. And whatever is a dividend, 30,000 into the 80% belongs to parent. So record that 80%. Remember, we are not passing this entry in the current year. We are passing this entry in the next year whenever we receive the dividend as a parent. Okay. Then what else was asked? They have asked to compute the NCI as per fair value method. How do I compute the NCI as per fair value method on day one? They are telling us to use the same ratio of purchased interest. We purchased 80% for 1,40,000. What will be the value for 20%? Simple. Okay. Then they have also asked the NCI on year end. So take the opening of day one of NCI. Then add the post share of NCI. Subsidiary earned 20,000 now. So 20% belongs to NCI. So add that. Okay, we added it. Then will I subtract the dividend? No, dividend adjustment is not there in the current year. It is in the next year. So don't perform the deduction in the current year. Do remember. Okay. Apart from this, an entry on day one was asked. What entry will you pass? Acquire the INA to PC to NCI. Difference goes to goodwill. Simple. Okay. So this was a very good question. Do remember that. There is an alternative case also discussed in 35, which is linked to 34. It is said calculate the NCI. Calculate the NCI using which method? Using PSNA method. So it is simple. Instead of finding the fair value of NCI, you will find the NCI using PSNA. So what will be the difference here? So your INA was 1,50,000, no? So your NCI will be 1,15,000 to 20%. Simple. Rest everything remains the same. Okay. Then what else is there apart from these questions? See, question revision is something which is very important, I feel. Okay. So do practice all of them. I am going to revise the major questions, but small questions like these which are there, just practice them once at least. Okay. Okay. Now we come towards illustration number 45. It's also simple. You can come towards illustration number 47. We can go through once. Okay. What is there in 47? Please have a look here. So let's say, for example, we acquire 10% additional shares of its 70% subsidiary. So we had 70% and we acquired 10% extra. Okay. So we already had control. So will I compute the 6 steps again? Will I solve all the 6 steps again? The answer is no. When you already had control, this extra 10% only has one effect. NCI will reduce and your stake will increase. Simple, right? What entry will you pass? Because you are purchasing, so you will say to cash bank. Because you will reduce the NCI, you will say NCI account debit. And difference goes to consolidated equity as discussed. Because NCI is an item of equity. If it reduces or increases, the difference goes to consolidated equity. Simple. Now, how much have you paid for that 10%? 2,600. So cash bank 2,600. Okay. How much NCI will reduce? It will reduce proportionately. 30% NCI is 6,600. So how much will be 10%? It will be cross multiplied. 2,200 it will come. So NCI will reduce by 2200. Difference comes on debit side, transfer to console other equity. Simple. This is how we will solve it. See, it is given here also as well. Are you getting my point? That also asked one thing, that will the goodwill change? Of course, goodwill will not change, because when control is not changing, goodwill will also not change. Okay, do remember that part. Acha, one more thing. Whenever such type of small questions are there, don't forget to write the concepts in 1 or 2 lines. Okay, quote your concepts in your own words in 1 or 2 lines. Okay, do remember that. Acha, one more good question is there. Illustration number 48. We acquire 70%. Okay, when the fair value of net asset was 200, profit made was 100. Then we acquired another 10%. So again the same case where we had control, now we are acquiring 10% extra. So what will happen? We will give out some money and our NCI will reduce because my stake is increasing. Okay, we are acquiring 10% for 32 lakhs. The proportionate carrying amount of NCI is 30 lakhs. So they have given the adjustment. Okay, now how will this affect the SFS and CFS? So in SFS, you purchase 10% or you purchase 100%. In SFS, it is just like purchasing an investment. So in SFS, your investment increases and your cash reduces. So the entry in your SFS is something like this: investment to cash bank. Simple. Okay, so your investment increases and cash reduces, balance sheet tallies. B's SFS will have no impact. What about group's CFS? In group, instead of doing 2 cash bank, because you have already done 2 cash bank in SFS, in CFS instead eliminate the investment. So NCI account debit to investment. Of course, balance if goes to console other equity. Now what will be the adjustment? This investment which gets created because of SFS will get eliminated here. Okay, cash balance, you write the revised cash balance because in SFS cash reduced, so CFS also reduced cash balance will come. Apart from that, your NCI reduces and the difference of other equity was on debit side, so your other equity in CFS will also reduce. So just prepare this balance sheet if it is asked. Okay, that's it, nothing else is there. Chalo, so a very simple question you can say. Okay, nothing substantial here. Now illustration number 49 is also there, I guess. Yes, illustration number 49. What is there in this question? Please have a look here. Amla purchases 100% subsidiary for 10 lakhs. Okay, when the net asset was 8 lakhs. Very good. Parent sold 40% investment. So we had 100%. That means NCI was 0. Now I am selling 40%. So my stake will remain 60. Can I say this is without loss of control? I still have control. This is without loss of control. I still have control, right? Okay. Now, if you see, if my stake is reducing, whose stake will increase? Can I say NCI's stake will increase? It is as simple as that. Whose stake will increase? NCI's stake will increase. So increase the NCI stake, guys. Okay. So what entry will you pass? You are selling. So you will get cash bank here. Your NCI will increase. Okay. And difference goes to console other equity. Chalo. So we sold for 9 lakhs. We will get 9 lakhs money. Parent still maintains a controlling interest. Carrying value of subsidiaries net asset is 2 lakh, including net asset of 16 lakhs and goodwill of 2 lakhs. Calculate gain loss of interest in subsidiary, but this gain loss we calculate in CFS and SFS both. Okay, chalo, how will I solve it? Please have a look here. So how much money I will receive, that is given, but we have to record the NCI 40%. At what value will I record the NCI? So see, I just prepare a simple chart. Previously, subsidiary had only one holder, 100% parent, NCI was 0%. Okay, now subsidiary has 2 holders, 60% parent, 40% NCI. Can I say NCI is there in this subsidiary only? So whatever is the value of subsidiary, 40% will be the value of NCI. Simple. So how much is the value of subsidiary? If you take the INA plus goodwill, that will give you the fair value of subsidiary. In this subsidiary only we have 40% NCI, right? So you can take 18 lakhs ka 40%. That will give you 7.2 lakhs. Okay, so NCI will be recorded as 7.2 lakhs. Because NCI is increasing or reducing, difference gets transferred to other equity. Simple. Okay, so this is what is happening in CFS. Do remember a very important calculation of NCI. Then what about SFS? Do remember the logic of SFS and CFS is completely different. In SFS, you had acquired, you just see what was the carrying amount of your investment. So you had acquired the 100% investment for 10 lakhs. That means the cost of investment was 10 lakhs. Okay, assuming the investment stayed at cost only, you sold 40% of it. Now what will you do? Whenever anything goes out of a balance sheet, it goes out at carrying amount. So 40% investment will go out at carrying amount. You have sold for 9 lakhs, so record the 9 lakhs. Difference goes to profit and loss. This is a realized profit in SFS, so record in profit and loss. Simple. Okay, and I have given a note also. In disposal, the logic of SFS and CFS is completely different. Okay, one more thing. If you are watching the video on YouTube, I am uploading the board notes on my Telegram channel. You can download it. Okay, chalo. Let's proceed. Then 49 done. 50 is relatively very simple. 52 we will do later on. Then there is 53. Okay. So again a good question. 53. What is happening in 53? Please have a look here. Okay. So in March 11, a group had 60% interest in subsidiary. If I have 60%, can I say 40% was NCI? With share capital of 50,000 ordinary shares. That means subsidiary had 50,000 shares outstanding, out of which 60% was held by parent and 40% was held by NCI. Simple. Okay. Now, goodwill was calculated using partial goodwill method, which was 20,000. On 31st March 11, an option held by minority holders, that means option held by non-controlling interest, exercise the option to subscribe for a further 25,000 ordinary shares. They have subscribed for a further 25,000 ordinary shares at rupees 12 per share, raising rupees 3 lakhs. Okay, so they have subscribed for 25,000 ordinary shares at rupees 12. Who have subscribed? NCI has subscribed. Now, what is the implication of this? See, previously subsidiaries share capital was 50,000 shares, 60% was with parent, 40% was with NCI. Now, because just treated like that, subsidiary has made a further issue, and those whole further issue has been taken by NCI only, which is 25,000 shares. So NCI previously had 20, now they get more 25, total becomes to 45,000. Parents number of shares stays at 30,000 only. So if you calculate the revised stake, NCI's stake goes on to 60%, parent stake reduces to 40%. That means parent, without even selling a single share, his control is lost. Parents, without even selling a single share, his control is lost. So whenever there is loss of control, try to pass a simple entry. First pass, remember my hint, first pass the entry and then fill in the blanks with the amounts. What will be the entry? Remove INA, goodwill, NCI. 3 things removed. Next, you are selling something, so bank account debit. And if you are retaining any percentage stake, so investment retained account debit. Okay. Of course, your bank will be nil because you are not selling anything. Okay. So INA you will remove at 450, it was given. Goodwill you will remove at 20,000, it was given. NCI 40% will get removed because when I was the controlling party, NCI was 40%. But how much was 40% NCI? It is not given. It was missing. There was one hint given that goodwill is at PSNA. If goodwill is at PSNA, if goodwill is partial, goodwill is partial. If goodwill is partial, then NCI is at PSNA. So whatever is the INA, you can take the proportionate of INA as NCI. Okay. So you will get the NCI amount. How about investment retained? How will you calculate this? You have 30,000 shares retained. It is said that NCI on this particular date exercised each share for rupees 12. So this can be considered to be the fair value of share. So you will record the investment retained at 30,000 into rupees 12. 36,000. Okay, simple. So again, I'll repeat, whenever there is loss of control, first pass the entry. INA remove, goodwill remove, NCI remove. Okay, 3 things removed. Because you are selling, bank account debit, and if you are retaining any percentage, investment account debit. Difference goes to profit and loss. Simple. Okay, with practice, you will be able to crack this. It is very simple. Okay, let's proceed. 54 is very simple, nothing to do with this. 55 we can solve once. Okay, what is said, please have a look. 80 purchased 100% subsidiary for 50 lakhs. Okay. So we had purchased for 50 lakhs. That time goodwill was 10 lakhs. Very good. Okay. 80 sold 60%. Now we are selling 60%. So control gone, sir. For how much? For 67.50. Retaining a 40% investment. Here the good part is they have given the fair value of 40%. Retained portion. 45 lakhs. Calculate the gain loss. So control is lost, right? How will you pass the entry? Just try to pass the entry first. Control gone. So INA remove, goodwill remove, NCI remove. Because you are selling, bank account debit. And if you are retaining any stake, investment retained account debit. Simple. Now fill in the blanks. INA was given, goodwill was given. NCI will be nil because my stake was 100%, so NCI stake was 0%. Okay. I have sold 60%, so I will receive money for 60%. Balance 40% I have retained. Okay. So simple. Difference goes to profit and loss. Now what will happen in SFS? In SFS, remember, we are not concerned with loss or without loss of control. Okay, in SFS, just see what was the cost of your investment. Your cost was 50 lakhs for 100% investment. You are selling 60% out of it. So remove at the proportionate carrying amount. If 50 lakhs is for 100%, how much is for 60%? So it will 30 lakhs. Selling for 65 lakhs, 67.5 lakhs, difference goes to profit and loss, 37.5 lakhs. Simple. Clear, guys? Yes. Then you can come towards, see, these big questions we have already done. Then you can come towards this question. Illustration number 69. Okay, a very good question. Please have a look here. It says Reliance Limited has a number of wholly owned subsidiaries. Okay, including Reliance Jio Infocom. Now it says, what is the meaning of number of wholly owned subsidiaries? That means it has multiple subsidiaries. And wholly owned means they have 100% share. Okay. Reliance is the parents. Reliance Jio is a subsidiary. Simple. Okay. Now, how they have given the data, please have a look here. So they have given the CFS data of parent plus all subsidiaries. And out of this whole data, how much value belongs to the subsidiary? Belongs to this Jio subsidiary. Like for example, if goodwill is 190, 90 is the goodwill from Reliance Jio. If 1620 is the total asset buildings, 670 is the buildings from Reliance Jio. Why is it given separately? Maybe we might be disposing of this subsidiary. Maybe. Let's see. So they are asking us to prepare balance sheet after disposal when Reliance sold 90% shares of Reliance Jio. Okay. For 1000. So we are selling 90% shares. Control gone. Because our stake was 100%, selling 90%. How will you pass the entry? First pass the entry. Even if balance sheet is asked, first pass the entry. How will you pass the entry? See. INA remove, goodwill remove, NCR remove. INA remove, goodwill remove, NCR remove. Because you are selling, bank debit, and if you are retaining anything, investment retained account debit. Simple. Now, how much INA will you remove? So it is not given as a single amount, but you will see now. Apart from goodwill, have a look at all the assets and the liabilities. Okay. So if you see the INA, it is 1190. Remove the goodwill separately. Okay. NCI, it will be 0% because I was the wholly owned subsidiary. So NCI will be dash. 9. You are selling, so you will receive money. So bank account debit. Now the most important calculation. What will be the value of investment retained? It is not given directly. How will you find it? It is very simple. See, previously, this subsidiary had one holder. Parent 100%, NCI 0%. Now, in this subsidiary, can I say parent has retained 10% investment? So whatever is the value of this subsidiary, 10% will be the value of my investment. Okay. How will you find the value of subsidiary? Take the INA of subsidiary and take the goodwill of subsidiary. You will get the value of subsidiary. In this value, I have 10% stake. So this is the value of my investment retained. This is how I will find it. Okay. Same thing we did to compute the fair value of NCI also before 2-3 questions. Remember. Now, once you get this, you just need to give the effect of this entry. How? Bank account is increasing. So bank will increase by 1000. Investment is there. So investment will come 128. Okay. Then loss on disposal. So loss will affect your other equity. So loss. Then INA is getting removed. So whatever assets were there of this subsidiary, remove it. Just remove it. So let's say goodwill was 190. This 90 will go out. 100 will remain. Buildings were 1620. This 670 will go out. 950 will remain. It is as simple as that. And then just tally the entry. It will tally at 3, 6, 7, 8. Simple. Clear? Okay, sir. Great job. So, now illustration number 70. Okay. What is there in this question? Again, a very, very, very good question. Okay. Let's have a look here. What does it say? It says Airtel Telecom owns 100% share capital of Airtel Infra. So Telecom becomes the parent, Infra becomes subsidiary. On 1st April 11, Telecom acquired a building from Infra. Here the parent is acquiring from subsidiary. Basically, subsidiary is selling to parent, in other words. Okay. So who has earned the profit? Subsidiary has earned the profit. We will eliminate it in CFS. Anyways. Airtel Infra had purchased the building from third party on 1st April 10 for 10,25,000. I will just give you a summary of this question. What is happening? So first, on 1st April 10, Infra is the subsidiary. Subsidiary purchases himself. Okay. At 10,25,000. When the life was this, RV was this. Subsidiary uses this for 1 year. Subsidiary uses this for 1 year. Then after 1 year, subsidiary sells this to parent at 11 lakhs. Okay. So when subsidiary sells it, in SFS, subsidiary will book some profit. Okay. And after selling, parent is using for the another year. Okay. Now see, entry has been asked in 3 financials. One is the individual financials of subsidiary. One is the individual financials of parent. And one is the CFS of parent. Okay, what will subsidiary do in the individual FS? So whenever subsidiary purchases, he will pass an entry for purchase asset to cash bank. Then subsidiary himself uses for 1 year. So depreciate for 1 year. Value is given, life is given, RV is given. Find the depreciation. After depreciation, a carrying amount comes to 10 lakhs. Now on the immediate next day, subsidiary sold to parent. Okay, so subsidiary will say, I am receiving money. PP goes out to carrying amount and difference goes in profit and loss. So this profit subsidiary booked, but in individual statements. In CFS, we will eliminate this later on. Okay, let's see. Then what will parent do? Parent purchased for 11 lakhs. So that 11 lakhs becomes the cost of parent. PP to cash back. Then next is parent will use for 1 year. So depreciation to PP. Cost minus the RV divided by the number of years of life. Okay, simple. Now comes the CFS. What will I do in CFS? First immediate thing, as soon as you booked the profit in subsidiary, eliminate the same in CFS. Okay, so how to eliminate the profit? Debit the profit and loss, credit the asset. So profit is eliminated. That means in CFS, the asset which was worth 11 lakhs has now come down to 10 lakhs. Simple, after elimination of profit, because you are reducing the PP also. No? Okay, that means in CFS, you should depreciate on 10 lakhs. You should depreciate on this 10 lakhs. Should I charge the depreciation separately? No. In SFS, the debt has already been charged. So no need to charge in CFS, but just check whether it has been charged correctly or not. So if you calculate the depreciation on CFS, it should be charged on 10 lakhs. It is coming to 32,500. But in SFS, we have charged 37,500. Okay, that means in CFS, we need to reverse the extra 5,000 charged. Don't book the 32,500 again. We will say that out of 32,500, we have charged 37,500 already. Because we charged in SFS, the impact already came in CFS. So in CFS, just reverse this extra 5,000 charged. So entry for reversal is exact opposite of the normal entry. So normal entry is depreciation to PP. The reversal entry is PP to depreciation reversal. Simple. Okay, so in CFS, these two entries will come. Eliminate the URP, reverse the excess depreciation. Okay, chalo. So this was your illustration number 70. Very good question. Then we move towards one more concept, that is chain holding. Okay, chain holding. Now what is there in chain holding? Please have a look here. So basically here what happens is, there is one parent. He has a direct subsidiary. Okay, and this subsidiary has one more subsidiary. Okay, so for AK Limited, this becomes an indirect subsidiary. This Ajay Limited becomes an indirect subsidiary. This is chain holding. When you have a direct subsidiary and through this direct subsidiary, you also have an indirect subsidiary. So this parent will prepare CFS not with one subsidiary but with both the subsidiaries. Okay, so it will prepare CFS with Mukku also and with Ajay also. Simple. This is the meaning of chain holding. Now, first important calculation here is finding the effective stake. Okay, so AK has a direct subsidiary. So effective stake here is very simple. In Mukku, 80%, in NCI, 20%. Okay. Then effective stake in Ajay. How much will be the effective stake in Ajay? Simple. There is an indirect stake, right? So if AK has to find the effective stake in Ajay, do 80 into 70%, 56%. Balance will be NCI. Simple. This is how you find the effective stake. This is one important thing which you need to find. Okay. Then I have given multiple examples. You can just refer it. Then the next important discussion is date of effective control. Okay, so remember my example. Let's say for example, AK acquired control in Mukku on 1st April 11 and Mukku in turn acquired the control in Danish Limited beforehand only. Okay, so AK acquired control in Mukku on 1st April, but Mukku had the control in Danish beforehand. Now we want to prepare CFS from AK's point of view. When we will treat that AK has control. So with Mukku, AK will start preparing from 1st April 11. And with Danish also, AK will start preparing from 1st April 11 only. Why? Sir, why not 30th September 10? Because see, AK is having the control in Danish through Mukku. And AK acquired Mukku on 1st April 11 only. So it cannot have control in Danish before 1st April 11. Okay. So AK will prepare CFS with Mukesh on 1st April 11 and with Danish also on 1st April 11. Simple. Second case, if AK had control in Mukku on 1st April 11, but Mukku acquired Danish later on. So here AK's CFS with Mukku will start preparing from 1st April 11. But since Mukku on this date did not have the indirect control or this subsidiary, AK's control in this subsidiary will also come later on. That is on 1st October 11. Do remember that. Okay. Okay, then just to illustrate this, we have two illustrations. One is illustration number 52. Okay, so it is a very good question on chain holding. Let's have a look here. Okay, see, the chain holding solution is very simple. The only thing here is that CFS we were preparing previously only with one subsidiary. Here there will be two subsidiaries. Okay, prepare this consolidated balance sheet as on 31st March 12. P, S and SS. Their balance sheet on that date are given below. Okay, first P Limited has 80% in S Limited and 75% in SS Limited. Okay, this is given below. Do remember that. So this becomes a chain holding. Now data is given that P has acquired the investment in S. P has acquired the direct subsidiary for 340. This becomes the PC. And S acquired the SS for 280. Now what to do with 280? I will explain to you, don't worry. Okay, then read the balance sheet. It is very simple. First, data is written to stake. P holds 80% and S holds 70% in SS. Okay, though both their holdings were acquired on 30th September. So both the controls came on 30th September only. Business profits are accrued evenly throughout the year. Okay, then the opening balance of reserves is given. For S, what is the opening balance of reserves? That means in case of S, 80 is in opening, so balance will be in post. Same year also. Okay, similarly it is given for SS. It is given for INA basically, step number 2, pre and post you can do. Okay, and because the control came on 30th September, yet time adjustment will also come. Okay, for 6 months. Do remember that. But because the data of other equity is given on 1st April. Anyways, let's proceed. Important adjustment. 10 lakhs included in the inventory of S Limited is the inventory which has been purchased from SS Limited. In short, SS sold the inventory to S. Intercompany transaction eliminate the unrealized profit. Okay, who will eliminate the profit? Because SS sold to S, so profit was booked by whom? Profit was booked by SS. So who will eliminate? We will eliminate from the post reserves of SS. From the post reserves of SS. How much? It is said that cost plus 25%. This 10 lakhs is the selling price, of course. So if you back calculate it, you will get 2 lakh rupees. Okay, I have done the calculation also, don't worry. Then they are saying that NCI to be computed at fair value method and market price of NCI is same as face value. Now how do I solve this? Simple. First, always find the effective stake. P has a direct stake in S, so 80% S, 80% is with the parent, 20% with the NCI. P has an indirect stake in SS, so do 80 into 75%. You will get 60% with the parent, 40% with the NCI. Okay, date of effective control, both the controls came on 30th September 11 only. Now, first calculation is PC. Okay, the PC from whose point of view? We want the PC from P's point of view. Do remember that part. So P invested in S directly, 340. What about the PC of SS? We will discuss later on. Just hold on. Then find the INA. INA of there will be 2 subsidiaries. Okay, so simple. Just take the equity capital of S Limited. Then other equity bifurcate into pre and post. Do time adjustment. Whatever amount is in pre will go in INA. INA becomes 525 and post balance will bifurcate into parent and NCI. What about SS? Repeat the same process for SS. Only one thing extra will come, that is eliminate the URP. Okay. Okay. Third point. NCI. Now NCI we will not find using PSNA. They are telling us to find using fair value method. But direct fair value is not given. So one more method was to compute the number of shares held by NCI and multiply by the price per share basically. So how much shares does NCI have? It is simple. My stake in S is 80, so NCI is 20. So look at the share capital of S Limited. Okay, so S Limited share capital is 400. Divide by rupees 10, you will get number of shares. Out of this number of shares, 20% are with NCI. Okay, this is how we find. 20% is with NCI. Similarly, in case of SS, NCI was 40% from P's point of view. So whatever is the number of shares of SS, out of that, 40% is with the NCI. Simple. Multiply by the face value, you will get the NCI on date of acquisition. Then NCI on your end, take the opening value, add the post acquisition balance. One more adjustment is there. We will discuss this later on. Then goodwill GBP. Okay. For S, it is simple. PC plus NCI minus INA. What about SS? In SS, I did not tell how did we get at the PC. Now, the most important adjustment of chain holding. Please have a look here. What is the adjustment? The PC which we have for which S invested in SS is 280 lakhs. But this PC is from whose point of view? This PC is from S point of view. 280 lakhs. We don't want the PC from S point of view. We want the PC from P's point of view. So just apply one simple logic. S invested in SS. So S has 2 shareholders. Okay, this S who is investing the money has 2 holders. 80% parent, 20% NCI. Okay, so whatever S invested, Out of that, 80% will belong to parent. So this is the PC from parent's point of view. 280 into 80%. Okay. And 20% will belong to NCI. Okay. So this will reduce the balance of NCI. Why it will reduce? Apply the simple logic. Assume that S is using money of 280 lakhs to invest in SS. So it is using two people's money. One, it is using the parent's money. So parent will treat it like an investment. Second, it is using the money of NCI 20%. So if you use anyone's money, their balance will reduce. No? Apply that logic, simple logic. Okay. So 80% of that 280 will become the PC from P's point of view. And that 20% will reduce the balance of S NCI. Will reduce the balance of SS NCI. Do remember that part. That's it. Nothing else is there. You can just solve this question. Find the goodwill GBP for second part. In both cases, you get GBP. Console other equity is very simple. Parents opening balance plus post balance of both the subsidiaries plus the GBP amount, because GBP comes in capital is of other equity only. Prepare the balance sheet. It is very simple. Just write all the three amounts of all the three companies. Don't forget to eliminate the URP. And in balance sheet, there is one more adjustment. There were some intercompany bills receivable and bills payable. Okay, so bills receivable were 72 and 30, that is 102, and bills payable intercompany were 100. So whichever is the lower amount, eliminate from both. So net amount in bills receivable stays at 2 and in bills payable it is nil. Okay, so this is how you will solve the question of chain holding. One more question is there on chain holding, and that is question number 5. Okay, this is similar question, only one thing is different. I'll just explain this to you here only. Okay, question number 5 of MTP RTP. My book, it is question number 5. What is there? See, date of effective control. Okay, the only difference here is, here LX is acquiring the direct subsidiary on 110 and LX gets the control of indirect subsidiary on 30th September 20. So here, because the direct subsidiary came on first day, here there will be no time adjustment, and here the indirect subsidiary came in mid of the year, so here there will come time adjustment. Only this part is different, everything else is the same. Okay, and that adjustment I had also solved, where when this mid subsidiary invest in the indirect subsidiary, that PC is from not from parents point of view. We want the PC from parents point of view. So simple, do 85 into 15. Okay, because this mid subsidiary had two holders, parent and NCI. 85% belongs to parent, so it will be PC for parent. 15% belongs to NCI, so it will be reducing the balance of NCI. So this completes your chain holding. So just if I want to come towards the chart, what all things we have covered, just have a look here. We have covered this, goodwill impairment done, step acquisition done, disposal done. These small points, of course, I will revise, don't worry about it. And now the chain holding part is done. To be honest, if I discuss about CFS, these are the main points which you should know. These are the practical points. Of course, remaining points you should give it a read, but these are the main points which you should focus on. That means if a big question comes, it will come from these points only. Okay, do have a note of this. Anyways, chalo. So done with the chain holding as well. Okay, yes, chalo. So before proceeding, how about a quick revision of whatever we did from point number 7.1? Please have a look here. Okay, please have a look here. See, first of all, we discussed one question where there was disposal in multiple transactions. Okay, so if the time gap is very small, treat it like a single disposal. Okay, first point was this. Then the next point was point number 8, and this was when the subsidiary has preference shares. So out of profit, first eliminate the dividend on preference shares, and then the balance profit will be distributed between parent and NCI. Okay, then elimination of intragroup transactions. Okay, if there is any intragroup transaction, sale, purchase, debtor, creditors, bills, so bills payable, eliminate it. Also, if there is any unrealized profit element, eliminate that also. Okay, then uniform accounting policies. The policies followed by parent has to be followed by subsidiary also, only for accounting policies. Okay, example, inventory. If the inventory is of same nature, they have to follow the same policy. And whose policy will they follow in CFS? They will follow in CFS parent's policy. If the inventory nature is different, then different policy is allowed. If they ask for PP depreciation, that subsidiary is following SLM, parent is following WDV, doesn't matter. In case of depreciation, different methods can be used. Do remember this part. Okay, next point. Can NCI be negative? The answer is yes, it can go negative. Why can it go negative? If you want, you can have a look here. Okay, so let's say NCI's day one balance was this much. As soon as subsidiary incurs a loss, this loss will be bifurcated between parent and NCI. So if the loss bifurcated to NCI is more than the day one's balance, NCI can go negative. So let it go negative. Okay, don't restrict to zero, let it go negative. So there's one question also where subsidiary was incurring constant losses. So keep on what you can say, allocating the loss to NCI. At one point it will go negative, it is fine. Okay, let it go negative. And then when the subsidiary earns profit, NCI later on can become positive as well. Okay, a simple question. And then apart from this, we discussed about reporting date. Now what is the meaning of reporting date? Reporting date simply means that year end, the parent and subsidiaries year end can be different. If they are different and if the time gap is of less than 3 months, in that case we can use subsidiaries. Let's say for example, parent year ended on 31st March 12 and subsidiaries year ends on 31st December 11. So we can use the data of subsidiary as on 31st December 11 and ask the subsidiary to send 3 months additional data for the purpose of CFS, because CFS will be prepared at the parent's year end. But if the time gap is of more than 6 months, if the time gap is of more than 3 months, let's say time gap is 6 months, in that case we cannot use subsidiaries this financials of different year end. We will tell subsidiary that you have to send us a draft FS of the same year end as that of parent, okay, for the purpose of CFS. This is what we have discussed till now. Okay, clear with this? We are done till point number 12. Now let's resume from point number 13. Acquisition in subsidiary without consideration. What is the meaning of this? So in this case you acquire the control without any stake. Okay, so how to acquire the control? As discussed, we might acquire the control by way of contract. So in this case you have the control but your stake is 0% maybe. Will you prepare CFS? The answer is yes, because if you have control you have to prepare CFS. The only difference is in this case your stake will be 0 and NCI will be 100%. So we discussed with one example also, right? When we prepare the CFS, your PC will be 0, INA will be the amount of INA of subsidiary, NCI will be 100%. So there will be no goodwill GBP here, because whatever is the INA will become the NCI itself. Okay, so this was the acquisition of control without consideration, okay, or without any stake, you can say that. Next point is that chain holding already done. Console profit and loss, as of now there is no question or concept in your book. If it comes in future we will definitely solve it. As of now you can just give it a read. If you have studied in CA Inter, you might have any question in CA Inter, just give it a read, or otherwise you can skip. Till now, if there is any question in future, I will definitely discuss it in future. Chalo. Control evaluation. Remember I gave you a 2-page theory on this. Just read that theory once. Okay, we discussed the relevant part of it. Just read that theory once. Okay. Then exemption from CFS. This is the important part. Okay, who is exempt from CFS? So there are two parties who are exempt from CFS. If you remember, one is the middle parent and one is the investment entity. What is the meaning of middle parent, sir? Remember chain holding, AK has a direct subsidiary and this direct subsidiary has one more subsidiary. So can I say AK will prepare CFS with both of them? But there is one more parent here, Mukku Limited, who is a parent of Ajay Limited. Mukku is exempt from CFS provided 4 conditions are met. First, Mukku is a wholly or partially owned subsidiary of another company. That means Mukku himself is a subsidiary of AK. Second, Mukku should not be listed. Third, Mukku should not be in the process of listing. And fourth, Mukku's ultimate parent is preparing CFS for public use. So Mukku's parent is AK. AK is preparing CFS for public use. Simple. Apart from this, the second company who is exempt is investment entity. So who is an investment entity? Who obtains funds from investors, who holds investments only for capital appreciation or investment income, because their motive is to just earn the return on investment. They are not willing to control any company. That is why they are exempt from CFS. And third thing, when they record the investment in SFS, they have to show all the investment in FVTPL. It is compulsory. Okay. So if let's say AK has investment in 4 companies, and if AK is an investment entity, it is exempt from CFS. But in SFS, he has to show all the investment in FVTPL. Okay. Achha, but there are 2 exceptions here. That means in the below 2 cases, CFS will have to be prepared. Okay. First case, if you are a mutual fund company or investment entity and you have a subsidiary who is also an investment entity, then you have to prepare CFS for this subsidiary. First thing. Second thing, if you are an investment entity, you have 4 subsidiaries, you are exempt. But let's say you are also a subsidiary of some other company. That means you also have a main parent, and this main parent is a normal company. It is not a investment entity. Let's say this AK is a investment entity which has 4 subsidiaries, but this AK has also one parent of MRU. MRU is into legal consultancy. So this MRU is not exempt. MRU will have to prepare CFS with AK also and with the indirect subsidiaries also, with all of them. Okay. Apart from this, we also did 2 more questions. which discussed about the change in the status of investment entity. I will quickly revise those questions as well. Which was those questions? First one was illustration number 58 if you go to see. Okay. What was there in illustration 58? So it was investment entity previously. Now it became a normal company. So when you become a normal company from investment entity, so previously you were exempt with any subsidiary. Now you become a normal company. Now, if you had any subsidiaries previously, you have to start preparing CFS. So this date when you change the status becomes a deemed date of acquisition of control for your old subsidiaries. So whatever subsidiaries you had previously with whom you were exempt, now you have to prepare the CFS. So that is exactly what we did. Okay. There is one more question, illustration number 59, where what is happening? Where you had a subsidiary. Previously, you were a normal company. Now you become an investment entity. So when you were a normal company, you were preparing CFS. Now, as soon as you become an investment entity, you are exempt. That means you will have to stop. You can stop preparing CFS. So this date when you become the investment entity will be treated like deemed date of disposal of loss of control. So it is as good as you are selling the investment in subsidiary. So deemed date of disposal. So you will pass the entry for disposal, remove the INA, remove the goodwill, remove the NCI. Okay, debit bank, debit investment retained. The only difference is because my subsidiary was 100%, NCI will be 0. And because I'm not selling anything, I am stopping the CFS preparation because I changed the status of investment, change the status from normal company to investment entity. But here I'm not selling anything. So bank will also be 0. So whatever is retained will be your investment retained at fair value today. So whatever difference is there, transfer and gain loss. So what is the difference between 58 and 59? In 58, we were a investment entity. Now we become a normal company. In 59, we were a normal company. Then we become an investment entity. Okay. So these are the main points which you need to focus in CFS. I have tried to revise all the points together. So I hope this revision was helpful. I hope this chapter was helpful for you. Okay. So thank you so much. I will just end this session as well. And just one thing, practice makes a man or woman perfect. So you have to practice. If you are not going to practice, then to be very honest, it is going to be of no use. Okay. So you have to practice it, guys. Okay. And on that note, we can wrap up the session.